Have you ever opened your pantry and realized that, well, nearly every single flavor, spice, or sauce looking back at you is about to be owned by the exact same company? Welcome to today's Explainer. We're looking at a literal tectonic shift happening right now in the global food industry. McCormick, the titan of taste with a 136-year history, has just announced a genuinely jaw-dropping plan to merge with Unilever's foods business. We are talking about combining two massive, highly complementary portfolios to create a true, preeminent global flavor powerhouse. It's the kind of deal that promises to completely reshape what's on our kitchen tables. But as with any transaction of this sheer magnitude, the financial mechanics and the execution risks, they're just as spicy as the products themselves. Let's get into it. So here is the roadmap for today. First up, a flavorful mega merger. Second, structuring the transaction. Third, key growth and synergies. And finally, navigating merger risks. All right, Section 1, a flavorful mega merger. You definitely recognize these iconic household staples, right? French's Mustard, Frank's Red Hot, Cholula, Old Bay. But by combining with Unilever's foods business, which, by the way, brings absolute global juggernauts like Knorr and Hellmann's to the table, McCormick is aiming to effectively triple its business. No small feat. This transformative combination is really all about taking McCormick's heavy dominance in North America and blending it directly with Unilever Foods' massive infrastructure and distribution network. We're talking across Europe, the Middle East, Africa, Latin America, and the Asia-Pacific regions. It's a huge footprint. To really understand the sheer scale of this new combined company, just consider this number, $20 billion. That is the estimated fiscal year 2025 combined revenue of these two entities. So we're talking about establishing a highly focused premium business operating at an unprecedented scale across both retail and food service channels. And they're targeting categories that have incredibly attractive consumer tailwinds right now. Moving into Section 2, structuring the transaction. Fair warning, we are about to look under the hood at some complex financial plumbing here. Okay, let's dive into this and see exactly how the new corporate pie is going to be sliced up. Post-close ownership breaks down with current Unilever shareholders expecting to own 55.1% of the fully diluted combined company. McCormick shareholders will hold 35%, and Unilever itself will retain a 9.9% stake, which they actually plan to sell down in an orderly fashion over time. Now, structurally, the separation of Unilever's foods business is expected to be a reverse Morris trust. Sounds complicated, but it's essentially a highly strategic, tax-free spinoff. It's designed specifically to avoid U.S. federal income tax for Unilever or its shareholders, brilliantly mitigating some of that heavy tax friction you usually see in cross-border megadeals like this one. This massive purchase prices out to a total enterprise value for Unilever Foods of roughly $44.8 billion. To put that into perspective, that's about 13.8 times their expected 2025 earnings. But the absolute most critical component here is the $15.7 billion one-time cash payment going to Unilever. Obviously, to pull this off, McCormick can't just check its couch cushions. They're relying on cash on hand combined with some significant new debt. In fact, they've already secured $15.7 billion in committed bridge financing from major players like Citi, Goldman Sachs, and Morgan Stanley just to fund this specific cash component. Section 3, key growth and synergies. Let's look at the exact recipe for this anticipated growth. Now, what's really interesting about this quote from McCormick's CEO, Brendan Foley, is that he points out a crucial differentiator. He notes the new company focuses on flavoring calories while others compete for them. This is literally the absolute core strategic thesis of the merger. McCormick and Unilever Foods aren't fighting in the brutal trenches of center-of-plate proteins or basic commodities. Instead, they sit right on top of those calories. Think about it. No matter what diet trend is popular this year or what specific protein consumers are buying, people still demand flavor. By refusing to compete for the calories and instead owning the flavor profile of the entire meal, this combined company builds an incredibly powerful defensive moat around its business. Let's move along and see how this builds out over time. Looking at the integration timeline, the financial models are pretty aggressive. Within the first 12 months post-close, they expect mid to high single-digit boosts to earnings per share. By the end of year 2, the integration teams, who, by the way, are already actively planning their roadmaps, aim to have 2/3 of the total synergies realized. And by year 3, they expect to achieve the Holy Grail, $600 million in full annual run rate cost synergies. That's going to be driven primarily by efficiencies in procurement, manufacturing, and general administrative overhead. So the crucial point here is the ultimate goal, which is a 3 to 5% target growth rate by year 3. And they plan to achieve this not just through slashing costs, but by taking an additional $100 million in incremental cost and revenue synergies and strategically reinvesting it right back into the business to drive top-line volume. Throw all that together, and they're projecting an expected operating income margin of roughly 23 to 25% in that third year. Finally, Section 4, Navigating Merger Risks. It's time for a sober look at the financial realities here. McCormick absolutely has undeniable defensive qualities, right? They operate in historically resilient consumer staples and high-growth categories. However, we have to acknowledge they are facing intense consumer headwinds. Right now, inflation is essentially forcing shoppers to trade down. Consumers are leaving expensive center-of-plate meats for cheaper cuts and heavy starches. Now, while cheap cuts do require bold, zesty flavors, which, ironically, actually benefits McCormick, there is still a massive risk tied to pricing, volume, and those overall consumer trade-down behaviors. The absolute worst-case scenario for investors is that the merger completes, but the consumer environment is so weak that those promised synergies fail to actually yield the desired bottom-line results. And this brilliantly illustrates the real elephant in the room, the debt. To make that $15.7 billion cash payment we talked about, the company's net leverage, which is the ratio of their debt to earnings, is going to spike to an estimated 4.0 times at closing. Now, management has explicitly stated their corporate goal to use strong cash flow from operations to rapidly delever back down to 3.0 times within 2 years post-closing. But the execution risk here is sky high. If the integration hits speed bumps, or if cash flow dips due to those consumer headwinds we just discussed, well, getting that leverage down will be incredibly difficult, and the stock price is definitely going to suffer for it. Which leaves us with this final, vital question to ponder. Will the $600 million in projected cost synergies ultimately justify the massive post-close leverage and execution risks? The anatomy of this mega merger reveals a truly brilliant strategic vision to dominate global flavor, but it requires near-perfect execution of a highly complex financial and operational integration. Only time will tell if McCormick and Unilever Foods have mixed the perfect recipe, or if they've taken on just a little more than they can chew. Thanks so much for joining me for this explainer, and hey, keep an eye on those grocery aisles, because the flavor landscape is officially changing.